A lot of people are calling for a bear market right now, and there is a possibility that they might be making the biggest macro mistake of the cycle. Here's what I think they might be missing. We just hit the longest manufacturing contraction streak on record, 26 consecutive months. The reverse repo facility has drained from $2.5 trillion to basically zero. And on December 1st, just days away, the Fed officially ends quantitative tightening. 3 massive liquidity shifts, all converging right now, all pointing in the same direction. Today, I'm going to be breaking down the Fed net liquidity indicator, the single chart that connects all of this, and why the data is telling a completely different story than what all of the fear is showing. So hit the subscribe and like on the way in. And if you're not in our intelligence system with our risk models, get back there. We have a free trial going on right now. Put it in the pinned comment below. Start planning your accumulation or your exits for this cycle. This is built for the macro crypto investor. So check us out. So here's a simple fact. Markets do not move just because of narratives. I think the data has been very clear in signaling that. Markets move because of liquidity. Can markets coincidentally move with a certain narrative? Yes, but they move because of liquidity. When net liquidity increases, risk assets increase. When net liquidity falls, risk assets fall. Now, if you're paying attention, you might be thinking, wait a second, net liquidity has been falling since like 2022, but the S&P keeps going up. It's a fair question, but look at what's really driving the S&P. It's not broad strength. It's a handful of mega cap tech stocks riding the AI narrative. If you look at assets that are really liquidity sensitive, like crypto and small caps, the correlation holds insanely well. The Russell 2000 has gone nowhere since like 2022. Crypto got destroyed in the drain and only recovered as liquidity stabilized here and there. Divergences like this, they don't just continue to last. Either stocks correct down to meet liquidity or liquidity catches up. The thesis here is that liquidity is about to catch up. That's why this indicator that we're about to look at is so powerful. It distills all the Federal Reserve's hidden liquidity forces into one line that tells you whether money is flowing into markets or out of them. This is the tide. Everything else that we see is just waves. So here's the formula that I want to look at with you. You see on TradingView, net liquidity equals Fed balance sheet minus TGA minus reverse repo. 3 moving pieces, 3 completely different liquidity forces. But when you subtract them all, you get the real liquidity that risk assets respond to. So let's break down each one very clearly. Here's the Fed balance sheet. This is the foundation. I've been talking about this thing nonstop. The Fed balance sheet is basically the list of assets the Fed owns. Treasuries, mortgage-backed securities, emergency loans, facilities that they need to use. When the balance sheet grows, that's quantitative easing. Liquidity enters the system. Markets breathe. When it shrinks, that's quantitative tightening. Liquidity is being drained from the system. Markets have such a tough time in that environment. This has been the story for the last 2 years. The harshest quantitative tightening cycle in modern Fed history. We just went through it. But now that QT is slowing and coming to an end in just days, this component of the formula is stabilizing. Liquidity is no longer being aggressively removed from the system. Then we have the Treasury General Account, the TGA. This one is crucial. The TGA is basically the US Treasury's checking account at the Fed. It's literally where the government holds its cash. When the TGA rises, the Treasury is pulling money out of the banking system. Liquidity decreases. When the TGA falls, the Treasury is spending that money back into the economy. Liquidity increases. That's why the net liquidity line often looks inverse to the TGA. Every dollar the Treasury stores, that's a dollar removed from markets. Every dollar it spends, that's a dollar injected into the markets. And right now, TGA is historically elevated and it cannot stay this high. It has to be spent down. And when that happens, net liquidity expands. And then we have reverse repo. This is the part people probably understand the least, but it's one of the most important. Reverse repo is basically where money market funds can park excess cash with the Fed overnight for a safe return. When money flows into reverse repo, it's leaving markets and going into the Fed. When reverse repo drains, that cash flows back into the system. From 2022 to 2024, we watched reverse repo drop from almost $2 trillion down to almost zero. That was one of the biggest liquidity waves of our lifetime. And you might be thinking, well, why didn't that pump risk assets? Well, it offset the quantitative tightening drain that we just went through. It kept us from actually crashing harder. The reverse repo was a buffer, and now that buffer is gone. But here's the key point. Reverse repo can only drain once. We already used that wave. So the next liquidity impulse can't come from a reverse repo. It has to come from the TGA. And that's exactly what's setting up right now. So Fed balance sheet equals structural liquidity. Reverse repo equals money market liquidity. TGA equals fiscal liquidity. Put them together, subtract the drains, and you get the net liquidity tide. When the tide increases, markets increase. When it falls, markets fall. It's really that simple. And right now, that tide is bottoming. So let's connect this to the other chart that I've been showing nonstop in my videos recently, the PMI and the business cycle. PMI is the real-time measure of business conditions. Below 50 equals contraction. Above 50 equals expansion. And here's the most important thing. Markets bottom when PMI is weak and about to recover. And crypto can front run this very well. In every cycle, liquidity bottoms, PMI bottoms, risk assets explode. But here's what's crazy about this cycle. Liquidity is bottoming before PMI has even turned. That's not exactly normal. Usually, PMI might turn first, then liquidity. This time, the order is kind of reversed. This is why we can kind of look at it like we are in uncharted territory. We've had one of the harshest, longest PMI contractions since the 1970s, and we're getting a liquidity bottom before PMI recovers. That combination is incredibly unique. And historically, it's bullish. So let's look at what net liquidity is signaling right now. And let's kind of put this whole picture together. Quantitative tightening is slowing. Reverse repo is basically empty. TGA is extremely high and must be spent down. Budgetary spending is increasing. PMI is at deeply suppressed and contracted levels. And the net liquidity indicator is starting to flatten. Very simply, this is not a bear market setup. This is a setup that usually happens before a next major leg of a cycle. It doesn't guarantee immediate upside. It doesn't remove volatility, but it tells you where the tide is moving towards. And the tide right now is turning. So this is where I want to be very clear. People are calling a bear market at the exact moment liquidity is bottoming. They're reacting to price. They're reacting to volatility. They're not reacting to macro or macro data. They're kind of fighting the last battle that we've had over the last couple of years, not the one that's unfolding right now. We've never had PMI this low for this long, while liquidity is this close to flipping higher. This is the cycle inversion that not a lot of people are prepared for right now. This moment in the market is very uncomfortable. I get it. It's confusing. It's emotional, especially if you're on X or YouTube or on social media. But data always tells the story before price does. And emotion is usually useless in these cases. Liquidity is bottoming. PMI is close to turning. And the Treasury is about to inject a massive amount of liquidity back into the system. Is there a guarantee that this will all play out exactly as we might think? No, there are never guarantees. Anything can happen in this market. But why there's a lot of noise and there's a lot of emotion and fear out there in the market, it is so important for me personally to just focus on what the data is saying, especially the zoomed out data. I'm a macro long-term investor in the crypto space. And when I bring all of this together, I can't help but get bullish. I want exposure to these markets. And I'm not saying we're just going to pump next week or right when QT ends. This shift that is happening right now has taken years to set up in the way that it has. We've had years to prepare, and we have to be patient for whatever this turn looks like. So I'm just trying to present the data to you. I'm trying to be ready myself. If you enjoyed this content, please consider giving it a like. If you're not a subscriber, please subscribe, turn notifications on. And again, if you're not in our intelligence system, I invite you back there, everybody. We have a free trial going on right now. We have a ton of assets back there. You can plan your exits. You can set your strategies. You can see the best times to accumulate when risk is low, to sell when risk is high. And so join our members if you want to give us a shot and let us know what you think. Either way, everybody, I appreciate you watching. I will see you in the next video. God bless.